the National Bureau of Economic Research, who's given the job of dating recessions, keys off of 4 different indicators: payroll, employment, production, real income, and business sales. The employment is still rising, but it's the only one of the 4 components that's doing so. Real income is dropping. Business sales in real terms and industrial production are dropping. So 3 of the 4 key coincident indicators have turned down. We've had 2 consecutive quarterly declines in GDP. Worldwide, the standard for a recession is whether there's 2 or more declines in GDP. We already have that. That's not our standard. We rely on the National Bureau of Economic Research Cycle Dating Committee. In the face of this slowdown in demand, we're seeing a very rapid accumulation of inventories, which is going to be problematic as the year unfolds. Another difficulty is that the U.S. dollar on a trend basis is up about 35% from where it was 10 years ago. This is costing us export capabilities, which we're seeing in the big tickets. It also destabilizes the world because the rest of the world has a great deal of dollar-denominated debt. It also raises their cost of living because many of the commodities that they buy are priced in dollars. Europe is in recession. Japan is in recession. The Chinese government this week said, and the first time that I've ever known them to do so, that they would not hit their growth target. And moreover, they said that they would not penalize those that did not meet their targets, which is an indication that China is struggling very badly. And so the labor market, the payroll jobs holds up. But if we look beyond that, the rest of the economy is showing significant weakness. And in actuality, the labor markets may not be nearly as clearly improving as they appear, because we have 2 employment surveys. One is a household, which is less known, but in the last 4 months, there's been a huge divergence. One of the most unusual that I've seen. These divergences have occurred, but this is very large. In the last 4 months, the payroll jobs have increased 1,650,000, 500 odd, which came in the month of July, which was much more than was expected. However, we have an alternative survey called a household survey. The payroll comes from about 170,000 of our largest firms. It's not a complete count because we have 670,000 firms. But it is a favorite of a lot of people, including many at the Federal Reserve. But there is an alternative survey. It's called Household. It's derived from a very, very large random sample. In my opinion, the random sample has a very small error factor. And in the last 4 months, the household survey has actually declined about 170,000. In other words, for the 4 months, there's a divergence of 1,850,000. And both of these 2 series cannot be right. And I suspect that the household is the more reliable indicator, just as it was when there was a divergence going into the recession in 2000 and also into the great financial crisis in 2008. Time will tell, but the labor markets may not be nearly as robust as they appear to many.